The IRS just confirmed something that could cost you thousands of dollars starting January 1st, 2026. And here is what makes this so frustrating. Most Americans have absolutely no idea this is coming. They will file their taxes next year the exact same way they always have, and they will wonder why their refund shrunk or why they suddenly owe money. This is not speculation. This is happening, and the window to prepare is closing fast. If you earn a paycheck, run a business, have investments, or plan to retire in the next decade, this video is essential. What I'm about to explain could be the difference between keeping your money and handing it to the government by default. Stay with me, because by the end, you will understand exactly what changed, who it affects, and what smart taxpayers are doing right now. Back in 2017, Congress passed the Tax Cuts and Jobs Act, the largest tax overhaul in over 30 years. It changed deductions, brackets, and how businesses pay taxes. But here is the catch most people missed. Many of those provisions were temporary. They expire December 31st, 2025. Starting January 1st, 2026, major portions of the tax code automatically revert to pre-2017 rules. The IRS has published guidance on this. The Treasury Department has issued notices. This is codified law with a specific expiration date. If you are not paying attention, you will feel it directly in your wallet. This channel exists to give you clarity on exactly these situations. We read the actual tax code, follow IRS announcements, and translate it into plain English. No speculation, no hype, just the facts you need to protect your money. Let me break this down simply. First, the standard deduction is shrinking significantly. Right now, single filers can deduct over $14,000. Married couples get over $29,000. When the law expires, these amounts drop back to pre-2017 levels. You could lose $6,000 to $7,000 in deductions as an individual or over $12,000 as a married couple. That means more taxable income and a higher tax bill. Second, the tax brackets are shifting. The top rate goes from 37% back to 39.6%, but it is not just the top bracket. The thresholds for all brackets adjust, meaning many middle-income Americans get pushed into higher tiers even without earning more money. Same paycheck, higher taxes. Third, the child tax credit drops from $2,000 per child to $1,000. For families with multiple children, that is thousands of dollars less every year. Fourth, the qualified business income deduction disappears entirely. This currently lets pass-through business owners deduct 20% of their business income. If you run an LLC, S-Corp, or sole proprietorship, this deduction might be saving you $10,000 or more annually. It vanishes in 2026. Fifth, the estate tax exemption gets cut roughly in half. Currently, individuals can pass on nearly $13 million tax-free. After the sunset, that drops to around 6 or 7 million. If you have built wealth through real estate, business, or investments, this directly affects your legacy planning. This is not abstract policy. This is about your paycheck and your family. If you are a W-2 employee, the shrinking standard deduction hits you directly. A family earning $75,000 with 2 kids could see their federal taxes rise by $2,000 or more annually just from the deduction and credit changes. If you own a small business, the stakes are even higher. Losing the QBI deduction on $200,000 in business profit means losing a $40,000 deduction. At a 24% rate, that is nearly $10,000 more in federal taxes every year, plus state taxes on top. If you are a high earner, the bracket changes, and higher top rates will cost you thousands annually. And because all thresholds shift, even households earning $200,000 will see meaningful increases. If you are retired or approaching retirement, the estate exemption change matters. People who own appreciated homes, built businesses, or accumulated retirement savings need to revisit their estate plans before this takes effect. The bottom line? If you pay federal income taxes in any meaningful amount, you are in the crosshairs of these changes. Here is what concerns me most. The hidden risk is not just that taxes are going up, it is that most people will not adjust in time. They will make costly mistakes based on outdated assumptions. Millions of people max out traditional 401k contributions, assuming their tax rate will be lower in retirement. But if brackets shift unfavorably, you might pay more taxes later, not less. That assumption needs to be reconsidered now. Business owners face a trap too. Many structured their compensation and distributions around the QBI deduction. When it disappears, that structure becomes inefficient. If you wait until the deduction is gone to adjust, you have already lost the opportunity. Estate planning procrastination is especially costly. If your estate would be tax-free under current exemptions but taxable under the new ones, you have a limited window to make strategic gifts or establish trusts. Once 2026 arrives, that window closes permanently. The IRS will not warn you. Your employer will not adjust your withholding proactively. You alone are responsible for understanding these changes and acting accordingly. Every tax law change creates opportunities for those who plan ahead. Here are legal strategies informed taxpayers are considering. Roth conversions. Moving money from traditional retirement accounts to Roth accounts means paying taxes now at current rates. If rates go up, you have locked in the lower rate. For people with significant retirement savings, this could save tens of thousands over a lifetime. Income acceleration. Normally, you defer income. But if rates are rising, recognizing income now at lower rates might make sense. Business owners might take larger distributions in 2025. Investors might harvest gains now rather than later. Maximizing QBI. Since this deduction expires, 2025 is the year to ensure you qualify for the full 20%. Review your structure and compensation with a tax advisor. Strategic gifting. The current high estate exemption allows tax-free wealth transfers. Making gifts now removes assets from your estate while the exemption is at its peak. Charitable bunching. As the standard deduction drops, bunching multiple years of charitable donations into one year can help you itemize and maximize the tax benefit. Here is a practical approach to consider. Step 1. Understand your current tax picture. Review your latest return. Know your marginal rate, whether you itemize, and what credits you claim. Step 2. Project your 2026 taxes under the old rules. Estimate the magnitude of the change so you know how much planning effort is worthwhile. Step 3. Evaluate Roth conversions. Determine if converting some retirement funds at current rates makes sense for your situation. Step 4. If you own a business, review your entity structure and compensation strategy. Does your current setup still make sense without QBI? Step 5. Consider income timing. Can you accelerate income into 2025 to take advantage of current rates? Step 6. Review your estate plan with an attorney. Understand how the exemption change affects your goals. Step 7. Adjust withholding and estimated payments if you expect a higher burden in 2026. Step 8. Stay informed. Congress could extend provisions or let them expire. Following reliable sources keeps you ahead. The hard deadline is December 31st, 2025. Once 2026 begins, the current rules are gone, but the effective deadline for many strategies is earlier. Roth conversions need to settle by year end. Gifts and trusts take time to structure. Business elections require advance notice. If you wait until December to start thinking about this, certain options may already be off the table. The practical deadline to begin planning is now. Tax professionals get extremely busy late in the year. Starting early gives you better access to quality advice. The cost of inaction is measurable. $5,000 in higher annual taxes, compounded over 10 or 20 years, is significant money. The decisions you make in the next several months will have consequences for years. Here is something important about the American tax system. It is designed to reward those who understand it. Two people with identical incomes can pay vastly different amounts simply because one knew about a strategy the other did not. The wealthy hire tax attorneys and CPAs not to cheat the system, but because they know the system offers legal advantages to those who seek them. The same advantages are available to everyone willing to learn. The informed taxpayers always knew these provisions would expire. They have been planning. They will be ready. Meanwhile, millions will be blindsided. If you are watching this, you are already ahead. That initiative is what separates people who build wealth from those who wonder where their money went. Here's what I want you to take away. Significant changes are coming that will affect millions of Americans. Some will pay thousands more in taxes starting in 2026, but you still have time to prepare. You have legal options, and now you understand what is actually happening. I am not here to sell you anything. I am here to give you clear, accurate information based on what the tax law actually says. That is what this channel does. We take confusing tax topics and explain them in plain language so you can make informed decisions. If this was helpful, subscribe to Tax Code Insider. We cover IRS announcements, law changes, and legal strategies for everyday Americans. No hype, just substance. Turn on notifications so you never miss an update that could affect your money. Share this video with someone who needs it, a business owner, a retiree, anyone trying to make smart financial decisions. Spreading awareness helps everyone. Thank you for watching. I will see you in the next video. Stay informed, plan ahead, and remember, in the American tax system, knowledge is literally money in your pocket. Take care.